Now with me this morning we have Laurence Marsh, analyst at Winterflood Securities, who will hopefully give us a market maker's perspective. And providing an analyst's view is Peter Ashworth, smaller companies analyst at Stanley Securities. He joined Stanley in 2002, having worked previously for Tether and Greenwood, Albert E. Sharp, Citicorp, Vickers and S.G. Warburg. He specialized in the small and business sector for 25 years. And finally, to get the broker's take, we have Chris Hardie. Chris has worked in corporate finance for 25 years, having been at Dresdner Kleinwort, Benson and Charterhouse. Chris is currently Corporate Finance Director at Arden Partners PLC, a quoted investment bank. Thank you all for joining us today. I think we heard from Minister Gork some very certainly positive contributions that government is making, both in terms of direct funding and also indirect funding to the small and mid-cap businesses. We heard about the tax incentives on corporation tax, the incentives on EIS and VCT. I would say we probably heard very little on tax incentive for equity investment versus debt. We heard a lot about tax simplification and, of course, the work on producing a workforce that is fit for purpose for the future growth of this country, both in terms of education and flexibility, and the number of task forces that are doing some very good work on this. The one thing I don't think we sort of touched upon is confidence. And I think that is the big question that I'd love to hear the views from the panel, but also from the floor, because actually if you look at the private sector, which David talked about, at the moment they're hoarding about £750 billion worth of cash. If one can get the private sector to invest a little bit of that cash, say 10% of that, that would mean a 5% move in UK GDP. But how do you get the confidence in the economy when every day's headlines are about the Eurozone crisis and the impending, I guess, Armageddon that could result from that crisis? It really is for me, as someone who came from the world of business, the big question. And what can government do about that? I'm looking forward to the contributions from our panelists, but also from the floor, because I will share with you that tonight I am giving the keynote speech of the Reform Dinner on this particular subject. So I'm going to use today as my own little focus group to get my speech written this afternoon. So I will pass over to our first speaker on the topic. So Laurence, over to you.
Okay, good morning. Most of you probably know Winterflood Securities, but for those that don't, I'll just briefly tell you. We were formed in 1988, so we've been running 24 years. We are primarily a market-making firm, and we are a 100% owned subsidiary of Close Brothers, which is a FTSE 250 merchant bank. We are the largest market maker in London on retail volume and coverage of the market. We cover the whole of the market today. We trade in everything, every shares, iShares, ETFs, but I guess our name is primarily associated with the small and mid-cap sector, which is where we originally started. And our founder, Brian Winterflood, has always been a champion of the small company sector. I think all things go in cycles. Looking back, I mean, I've been in the city 30 years. We've been in business some 20-odd years at Winterfloods. And in fact, when we started in 1988, it was a very difficult time economically, and trading was very poor. And then within a year, there were a number of competitors of ours who withdrew from the market, so that made when the market turn did come, it made it much more attractive for the ones that were remaining. And I think we're going through that sort of period at the moment in the general economy. We had a huge boom, not only in this country but in many other countries around the world, in excess spending, leverage, both from governments and individuals. And basically it's payback time. And when you have that happening, and it happens very suddenly, it can be very painful. And I think it shocks people, and people become very wary and are unsure of how to invest their capital. I think the problems with the London market are temporary. Liquidity is poor at the moment because the volumes are down. The more volume you have, the greater liquidity you would have to trade shares. And at the moment, the demand, if you like, for equity investments has declined significantly, and we're starting to see, for the contrarian investors, which could be a very good thing, headlines calling for the death of equities. I think this is, quite frankly, a load of rubbish. It's been seen many times over the last 30 years, and it usually signals at some point in the next period of time the beginning of a bull market. Now, I don't want to get carried away. I don't think anything's going to start imminently. There are a number of situations that have to be resolved, but I think we can't focus totally on the negativity. A businessman, if he's going to create a business, develop new products, open new factories, he has to look at what can be done and look at how it can be funded on that day, and he will have carried out all his work regarding the demand for his product. And if he was to sort of pick up the FT and look at the headlines, he's going to a state of shock. He just has to focus on the business, and that's what I think most business people will be doing. As regards funding, I think there's still funding around for the right company and the right story. It's less than it was a few years ago. If we take the AIM market as an example, it's been in existence now just over 15 years. I think something in excess of £70 billion has been raised in that period. 3,000 companies have floated. Probably just over 1,000 are still quoted today. And I believe something to the order of 10 billion has been raised, new equity finance has been raised in the last 5 years. So it's still functioning. And if you take it as a market on the global stage, it is, I think, by far the most successful small cap growth stock market available. Many other countries, we've regularly hosted visits from people overseas looking at the AIM market, and many of these countries have tried to emulate that and have failed abysmally. And I think our market works because we've got the right system. The stock exchange, in their foresight, created the right structure to enable people to trade very efficiently. We have the market maker system that acts as a catalyst, acts as a liquidity provider to ensure that the market can function in an efficient manner with two-way prices, and it works. At the moment, demand is low. There's no reason to believe it won't recover as people's confidence recovers.
Thank you very much for that, Laurence. Peter.
That's a hard act to follow. My name is Peter Ashworth. I'm a small company analyst. I've got a number of former colleagues in direct line of eyesight, a number of people I've worked with and come across. And the sort of topics I wanted to cover, and I share Laurence's greater optimism than you'd believe about the market generally, but I think there's things that are going on that the market doesn't really spot or we don't really pick up, but as a panel of practitioners, we spot in the course of business, and I think they're relevant to the topics we've covered already. We were charged to talk about, can a mid-cap company grow in the current market? And this was the gentleman to my right's question early on. And Laurence is right, there are fundraisings going on, there are new issues coming along. This is not really garnering much publicity, but I think it's happening. You've got a panel of fund managers after us and this afternoon, and actually one of the questions about the sector generally is the net new money coming into the sector. And we've seen across sectors trade buyers operating, and the trade bar is demonstrably operating in the software sector, and we've seen companies going out. What does that tell you? That tells you, as Laurence said, that the market is not valuing these companies appropriately. The trade bar is operating, the private equity bar isn't operating, but the trade bar is operating, and smaller companies become part of bigger companies because there's a bit of TLC, and you also have a big management stake, therefore you need a recommendation of the value, and frequently that is significantly above the previous value. So that tells you the market is undervalued. One of the doyens of the sector we presented to a fortnight ago talked about no one knows what the right value of many of these small companies is, and that's because of illiquidity and also volatility. But actually, they went on to say this gives you a tremendous opportunity to get a significant stake and a portfolio unit size without too much disturbance on the price, and wait for the valuation to be crystallized either by an improvement in trading or, you know, someone else having the same view of a business. So the undercurrents and some of the sub-themes are actually more optimistic than you'd think. One of the other aspects we were charged about, what challenges do small companies face? Well, we demonstrably know that. You just have to read the papers and listen to what David was saying earlier. Actually, the opportunities are far greater. I had 3 sets of results yesterday. All of them were in line. One company said, well, I don't really want to do a roadshow, nobody wants to see me. And actually I said that's precisely not true, because actually people want to hear from someone at the coalface what running a company's like in 2012. And actually you give a far greater insight into sectors, subsectors and themes and trends if you talk to shareholders and investors. That's where the opportunity lies. I also think that, you know, you have to come back to some of the self-evident truths of small company management. These are businesses where the founders have probably mortgaged the house to start the business. You've got a significant management stake, you've got a significant internal shareholding, far bigger than bigger companies, and those self-evident truths come to the fore in a market like we're in at the moment. In terms of lending, we've all done this for a long time for a living, so we're sort of fairly sanguine about volatility, and I would say that obviously companies that disappoint, it takes a long time to rehabilitate, but a lot of people think that equity investors are more sanguine than lenders if something untoward derails a business process. And shareholders tend to be more sanguine than, say, bank lenders would appear to be, who change tack quite quickly. We're on the road with a small company lending opportunity at the moment, because we see that funding gap that David talked about. And precisely when you spot undervaluation creates opportunity, and I think that's what investors are looking for. And I appreciate and sympathise with companies who feel being quoted isn't delivering what they hoped and anticipated when the PowerPoint first went round. But actually, most companies get on with the job in hand, and survival and progress is achieved that way. And actually, small companies are far more interesting than larger companies, really, in many senses, because you get to exploit themes. You look at the movement in Wolfson yesterday on the Samsung deal, you look at all the tablet-related, and I'm not a technology analyst, I'm as far removed from that as you possibly could be, as Laurence will testify. Actually, meeting companies, talking about businesses is a far more inspiring opportunity in small companies than it is in bigger ones. There endeth the first lesson. Thank you.
Thank you very much for that, Peter. Chris.
Good morning. Arden Partners, as you probably know, is a small cap broker with basic origins in the Midlands. So we have a lot of engineering, manufacturing clients, but also a special subject in bringing Indian companies to the London market, which has been one of the brighter spots in the last couple of years. I would say at the moment that for new entrants to the market, the outlook is pretty murky, and I think that's quite natural, and it comes back to the point that Nadhim made about confidence. I think at certain points in the cycle, the bar gets lowered, and more or less mature companies can come to the market, and I think we're seeing a retreat from the market from some of those companies that came perhaps to the market too soon. I think to come to the market at the moment, you have to be a very much better company than perhaps 5 years ago. I do, however, think that for existing companies, the equity markets are there, and we have examples in-house of companies who want to make acquisitions, and in a sense, companies are being forced into the acquisition trail because they can't see much growth prospect in the UK, and they are getting support from their shareholders to do so, admittedly at a price. And these acquisitions have to be seen to be creating value and creating some scale. I still think the sub 50 million area is is a very difficult area and will continue to be so. But looking ahead, and I guess the point behind the question asked is, where do the markets pick up, where the sort of private incentives take off? I am positive about that, as is Peter and Laurence. I do think that there are some incentives there which will help to bridge the private sector and the public sectors, and I think the new VCT rules should help that. And indeed, we are seeing a number of small biotech and software companies coming to the market, all raising sort of relatively small amounts of money, but I think that is the market working. These small companies, some of which will succeed, some of which won't, get a springboard onto the market because of the VCT reliefs and the EIS reliefs, and I think that is an understated thing. But I think the bigger companies will need to show their quality, and they will need to be bigger perhaps than in the past. So I think what the markets need is a period of stability. If I look to overseas markets, look at the US and Hong Kong, and things are happening there. And I suppose if I have one black spot, it is that I think the UK is not so good on the technology side. I think it's bad at backing technology. Generally, I think NASDAQ does a better job for its companies. And I think in the renewable energy and green energy area, I think Europe is more open for business in that area. So it's not undiluted good news, but I do think the London markets are perceived as being a very high quality market, and some of the other pretenders who've tried to create strong equity markets have fallen away, and London has continued to shine in that area. So I think we have a very good record. Just going to the AIM market, which is after all the springboard for most small companies, it's interesting to see that there are now only 890 companies as against 1350 at the peak. I'm talking UK companies here. But the capitalization of those companies is actually larger than it was a year ago. And so I think there is still a very healthy market there. And I'm expecting that it will continue to prosper. And just finally, I think markets, these are sort of rather glib statements, but markets don't like uncertainty, and they've got plenty of that at the moment. I think confidence and stability is what's needed, and the government have put forward a good case for financial stability, but there are still some landmines around. I think if politicians can provide a stable platform, that's the most they can do. I think it's down to individuals and businesses to do the rest, and the markets will do their bit. Thank you.
Thank you very much, Chris, and to the rest of the panel for being so succinct and coming in well under time. So we've got plenty of time for questions. I think your point, Chris, about stability, I think the one thing that I'm sort of urging our government to do is to make sure that the Eurozone gets to a place where there is some decisions that get taken. We've had summit after summit, acronym after acronym, yet there's very little clarity as to where we're heading in terms of the sovereigns and other debts that are that need addressing. So we'll open the questioning to the floor. Who would like to ask the first question? All I would ask you to do is to introduce yourself before you ask your question. The gentleman in the middle here with the red tie.
Not that one.
Colin Glass, Surgical Innovations, but really the question is, wearing my hat as an accountant in practice, as a day job, and helping small companies develop. Peter Ashworth seems to understand that the management of small growing companies is absolutely key, and that investors, analysts and what have you need to understand it better. And on AIM, there are some very good companies. Sadly, the AIM market is very quiet at the moment, but in the meantime, there has been a growth in terms of equity in the business angel market. And I'd be interested to know what the panel's view is on the business angel market as a sort of prelude to coming back onto AIM, perhaps when the market is better.
Do you want to take this? I mean, I know from my own experience in Stratford-on-Avon that the Midlands is quite lively in terms of business angel market. Do you want to have a go at that, and then we'll go?
I actually think it's a very interesting market, the business angel, and I think the other thing is something a couple of months ago, I was looking at a sort of like a style magazine, I guess, and there was a pair of sunglasses made from an unusual material, and it intrigued me, so I went to the website, and it was the website wasn't actually of the manufacturer of the glass. It was a company called Kickstarter in America, which is a sort of an internet platform, if you like, where entrepreneurs, innovators, designers can put up their story and say, I have developed, in this case, a pair of sunglasses made from, I think, carbon or something. They would retail at this amount. I've already had discussions with XYZ. I need $500,000 to get it into production. Anybody interested? And if you subscribe, there's various levels you can subscribe at, from $50 upwards. You get perhaps a discount on the glasses, a free pair of glasses, whatever. And I think that's, for the very low end, that could be an interesting area that might take off over here. I think perhaps the term over here, one of the people call it crowdfunding. Obviously, there would have to be some sort of regulatory oversight of it. But I think the business angels is a very important area. But I also think that more could be done to stimulate the general investor interest in investing through some sort of greater tax incentives. I mean, if you invest in a VCT fund, obviously you get a tax break, but why not, if you invest in perhaps companies on the AIM market, which are potentially growth companies, which are going to, if they do well, provide greater employment and growth in the UK, why not have some sort of tax break for the amount you invest related to the period of time you hold that? So if you held it for in excess of a year, the gains hopefully you make would be taxed at a lesser rate, or even a small tax break for the amount you actually initially invest. I think that whole area potentially could be further investigated.
I think that's right. I mean, I think it's like the Pied Piper of Hamelin. People follow successful people around, and if a company has a history and a management team has a track record of delivering, it's very easy to raise money for that business. Equally, everybody wants to know what the exit is, and if the exit isn't evident, actually, you then go back a stage, and as we've been talking about, you have this sort of peer-to-peer lending. Also, we're very fortunate. We spend our days meeting companies and coming across businesses. You find out the most obscure facts of the world, and actually there's a myriad of ways to make money that you never thought you would be able to make money from, and you wish you'd thought of yourself. That's the thing about it. You get people. There's one thing I didn't talk about, which I meant to talk about, which isn't relevant to this question, but is relevant generally, is the whole income-seeking and dividend-paying debate. But equally, that there's cash looking for money and cash looking for homes, and actually a proportion of that cash should go into a relatively riskier investment if the returns are as great as they could be, and that does exist, and that remains to be the case. And peer-to-peer lending is an example of it in some senses, of people who have an successful formula and need finance and seek it from people who've been previously successful, and and you read about it all the time. People who put money in at the outset and have had a fantastic return as a result, and it's a fascinating area for us.
It's not really public market stuff, but I mean, anecdotally, I've had 3 children leave university in the last 3 years, 2 of whom have gone sort of conventional route into professions, but one of whom has started her own business. And I'm quite impressed by the amount of funding she's been able to find from local development agencies, from government. I've been able to find her funding for a start-up business, and she's been able to get up and running pretty quickly. The linkage from that to getting to a size where she might look at the public markets, I think it's a more difficult bit. So I think there is a lot of money out there for startups, because people are nervous about the public markets. But it's the second stage of that, which hopefully the VCTs will pick up and give people the development capital. But I think there's a lot of money out there if you know where to look, and I think it's a natural part of difficult economic circumstances that people, if they can't find a job, they go and do whatever it takes to set up. And once they've got over that nervousness of setting up by themselves, that's where the next entrepreneurs are going to come from.
Thank you for that. We've got a question here at the front.
Thank you. It's Stephen Streeter again, Forbidden Technologies. When we floated, we did an offer for subscription, and we had exclusively private investors investing, which is actually quite similar to this crowdsourcing idea that you go out and say, I've got a story, would anyone like to invest? But the brokers are very sceptical because, of course, almost all financing is done through placings where everything's stitched up in advance and they know that it's going to be subscribed. And it was a bit of a sort of offer subscription. Is it going to work? Is it going to be a disaster? You know, perhaps no one will phone up. And it turned out it was 20 times oversubscribed, so that worked out very well. But now when we look, you know, obviously a few years further on, and we say, well, perhaps we'd like to do a rights issue to include all these thousands of enthusiastic private shareholders. And everyone says, oh yes, but you know, will anyone buy? It's £500,000 minimum. Our float cost £30,000, to put it in context, 12 years ago. It's £500,000 minimum. And you know, for a small growing company, it's actually very hard to access these private individuals. And it seems to be a sort of government dumbing down. You know, you're not allowed to take any risks. And equity is risky, and the whole government sort of attitude seems to be, oh, well, you can't have private investors investing in equity because they might lose their money. They can't put their ISA money into an AIM company because AIM companies are growth companies, and that's risky. And actually, you know, anyone who's invested in Royal Bank of Scotland will know that the FTSE 100 companies are, you know, actually quite a lot riskier than the average AIM company. And it's a sort of attitude thing, and I'm sort of perhaps fortunate that I was, well, what used to be called, you know, one of Thatcher's children, and the cult of equity and these huge floats, and the whole attitude right from the government down is incessantly, you know, take risks, be an entrepreneur. And now, you know, I mean, we can blame European regulation, but the whole attitude seems to be much more, we've got to play it safe, got to play it safe. And now if we want to raise money, we have to sell exclusively to institutions who don't have the same sort of vibrant attitude to new technology and to growth. And I wondered if, you know, the future of equity finance, I wonder if you've got any ideas on how to reopen the market to the thousands of enthusiastic private investors.
It's very difficult. I mean, compliance and regulatory problems, you know, present a huge burden for the brokers that are handling fundraising issues, which I'm sure colleagues here will testify to. But maybe there could be some way that if you had a placing, that a percentage was made available to a very wide collection of smaller cap private brokers. In the early days of the USM, which the younger people here would call the unlisted securities market, which was, I guess, the forerunner of the AIM market. This is the beginning of the sort of Thatcher era, if you like, 1980 onwards. There was a big rush of new entrants to the market, and there's some fantastic companies at the time. I think Body Shop floated, I think, in 1983 at 90p. I remember taking Anita and running down to the floor of the stock exchange. And in those days, what would happen is the sponsoring broker would give our firm, which we were a different name then, we were still market makers or jobbers as they called them in those days, and perhaps one other jobber, they would give us a percentage of the issue, and we would post on our on the floor of the stock exchange, on the jobbing site, the name, this company's coming to market in 2 weeks' time, a little bit about it, there's a retail chain, whatever you, 10 million shares are being issued at 10p, anybody interested, put your name down. And we did that, and then we would collect that in and then allocate, pro rata to the brokers. And that would then ensure there was quite a wide distribution to a private client base. Now, that's a very antiquated way, but something along those lines, using technology and the internet and platforms and what have you, might be worth investigating going forward. I mean, one of the things that really grieves me is every year I read about horror stories of individuals in the UK being scammed by boiler rooms from overseas, and it never really gets stopped. I mean, and we're talking about tens, maybe even hundreds of millions of pounds a year. So you've got a group of people in the UK who really want to invest in potential growth stories, yet they're being scammed by overseas entities. If we only could find a way to tap that market in the UK in an efficient and regulatory accepted manner.
I think Laurence is right, yes, but I'm old enough to remember it too, actually, but how worrying. One thing I would say is the regulatory hurdle keeps going up and is not going to be rowed back. And as you rightly pointed out, bigger companies have failed. And ironically, most of the headlines you read are about sort of serious price moves in oil and gas and resource companies, and you all wish you had them and you wish you didn't have the ones that decimated. And I don't do that sector. And actually, but people are prepared to take that level of risk in that nature of business in parts of the world you didn't know that had the commodities that they now export for a fortune. What I find from Charles Stanley is a very big business. We have we had our figures 2 weeks ago, I think, and we have 15 billion under management. I'm reliably informed by the auditors. But we have 32 offices around the country, and I find when we take companies around our network, which is related to my business, there are individual money managers and clients who want to invest in small companies, are eager to do so despite the hurdles of the regulatory compliance, and that will get, as we speak, getting tougher in terms of know your client and appropriateness of investment. If you can get over those hurdles, those companies want to see companies, because you can't have all your money in FTSE, and the return on income is so low. Therefore, you've got to broaden the portfolio. Maybe when it quietens down, there might be a device and mechanism to allow individuals to invest in small companies directly. The only problem is when it goes wrong, you're a hostage to fortune, They don't seem to complain when it goes up, unfortunately.
Yeah, I think this is an interesting point you raise, and there used to be a thing called an intermediaries offer, which I thought was quite a good idea, but got rather lost in the wash. And I think something like that could be one could resuscitate, but it means a number of things. One that you have to continue to offer these things, because as Peter will tell you, his private client colleagues will moan at him if they don't get all the nice ones, and
they get left with the bad ones.
And complain if they get the bad ones. So it has to be a consistent group of offered to probably a number of, be it Charles Stanley, be it Brewin Dolphin, or other groupings. But these private client managers are very tied into model portfolios, and their ability to actually invest in early stage companies is quite limited. The trick is going to be getting to the people who actually want to, read in the newspaper and just apply off their own bat through the brokers. And I think some mechanism to do that would be, I think, be a very valuable way of getting more equity participation. So I think you've got a very good point.
Well, I think what you're also going to see is the government embracing peer-to-peer lending, and I think that particular move, that market, will probably evolve into peer-to-peer equity funding, and it probably is a business idea that somebody in the room or somewhere else could develop further.
Can we have 10% of the company?
Exactly right.
One of the aspects I think is relevant, and we haven't really touched on it yet, is, and there's companies I know I'd like to meet in the audience today, if you're in an industry that gives an investor exposure to a market that they can see will grow and has legs, people want to invest in that market. Many companies bemoan, quite rightly, their current valuation. They don't quite understand why the price is so low. Small amounts of shares have a disproportionate impact on valuation. That demoralises both internal stakeholders and external followers. But the fact remains that one of the things that I think is quite successful is if you introduce a company that has got a reasonable business case to a group of individuals, and you may only need half a dozen or so individual investors who buy and subscribe to the belief in the business, that has a proportionate impact on the valuation. That then stimulates the institutional audience to say, well, I've overlooked this, this is worth getting involved in. Then you get a re-rating. That then allows you the opportunity to raise further finance. Understandably, the biggest pay-end would be that if I do a rights issue, I've got to do it at a discount. That dilutes my existing holding. That's disproportionate impact on existing stakeholders. And why is the discount always 20%? It's because that's where my calculator sets it. Ironically, you do, and there are examples of companies that place stock above the price. And that just seems an anathema, but actually it means that we think the price is worth X, not the current price. And as I said in my ramblings earlier, undervaluation represents opportunity. You don't buy something on 8 times and see it at 10 times because you won't get out at 10 times. What you want is to identify a company. I've got companies with a capitalisation in cash. 3 of the stocks I looked at yesterday yielded 8%. And that's because the price has come down. No one knows what the right price is, and that represents opportunity to investors. And you have to take, as we would always say, a portfolio approach. But if you're yielding 8% and you get 0.5% from the bank, it's not difficult to see where you put the money.
We've got the gentleman at the front, and then we'll take one more.
Hi, I'm Edward Craft. I'm a partner at Wedlake Bell, which is a medium-sized law firm, and I'm also chairman of the QCA Corporate Governance Committee. Building on something you were saying, Nadhim, and it's about peer-to-peer lending. We've heard this statistic about the 750 million sitting on corporate balance sheets. Obviously, I don't have any analysis, but I strongly suspect that the balance sheets upon which that's sitting on is not the small and mid-cap sector. What effectively can be done to try and route some of that capital into this part of the sector in a meaningful way, rather than us talking about it and wishing it were to happen? How can we actually deliver it?
I'll let the panel come in, but one of the ideas that I have seen, that I've experienced, is some of the large caps effectively using some of that to invest in their supply chain. They know the supply chain, they understand it. It's much easier for them to value it and therefore invest in it. And we're seeing more of that, especially in my region, in the automotive sector. You're beginning to see the JLRs of this world looking at their supply chain and saying, how can we help you develop further? And so that's beginning to happen. The sort of the flip side of that, which again I've experienced, which is really worrying, is in, say, the FMCG sector. People like P&G and Unilever saying to their distribution chain, look, you take over more of our UK headache because we're investing in the developing world. So they're taking that money outside of Europe. So those two things, one is positive, one is incredibly negative. But over to the panel.
Well, I think I read an article recently about a businessman perhaps in the Midlands, where he had heard from 1 or 2 of his suppliers that they were having difficulty getting overdrafts. And he's created his own sort of mini bank, if you like. Now, maybe some sort of banking platform could be created whereby some of the super stocks in the UK, the mega billion stocks, could actually contribute to that, matched perhaps by something from the government. And that was another form of lending to the SME market.
We'd certainly like to see more banks setting up and sort of the barrier coming down.
Yeah.
And some of my colleagues, like John Wedward, would like to see RBS broken up.
A bank without any legacy issues, perhaps, run by business people.
Into a business bank and the rest.
Yeah.
Chris and...
I would say that the government's probably got enough banks on their hands already, but so I'm very nervous about sort of politicians jumping onto the commercial side, but I hope that new banks will set up. I believe that they will get there, and I think that's the best way to solve the problem, is more competition there, cutting back some of the existing banks in terms of the branches, and encouraging the startups.
Peter.
I think, as an analyst, and one of the things we hear, and fellow scribes in the room will testify, you hear some quite stark revelations about companies' bank relationships in terms of refinancing, arrangement fees, all those things that have an impact on the interest charge line in the forecast. That is very evident. It's evident that it's very difficult for small companies in their banking relationships, especially when some of them have to change at short notice because of the sort of the cab rank rule, that a certain proportion of an existing loan portfolio has to go to someone else with whom they have no relationship, with whom they have no working history of the characteristics and complexions and complexities of a business. And I hear that from companies, and obviously we're in the middle of the reporting season currently. That makes life very difficult. I said in my ramblings earlier, and as a person who's done it for some time, equity investors, I believe, and institutions are actually more sanguine in terms of holding small companies than bank lending exposure sometimes is, because sometimes the attitudes can change very starkly if you've maybe reached a covenant breach or something like that.
We'll take one final question, and then we'll end the session. Yeah, gentleman back. Again.
Thank you. My ears pricked up when I heard Chris mention Kickstarter. And I got quite excited, and then became slightly depressed when he started to talk about regulation. I mean, and then Laurence talked about compliance, and the point about Kickstarter, if I might say so, is that it actually raises quite large sums of money. Its biggest raise in 24 hours has been $10 million. Now, I accept that is from an economy 6 times the size of the UK, but still quite a significant sum of money. I don't know how that $10 million broke down, but its first big fundraising was $2 million, and it raised that from 60,000, and it was a palindrome. It was either 262 or 626 people. It was an average of $3.50 each. And as a response, as you probably know, to crowdfunding, the US has introduced the Entrepreneurs Assistance Act, known as the Jobs Act, which allows people to invest up to either $10,000 or 1/10 of their annual income with no regulation whatsoever. Now, I think that $10 million is a bit too high. But investing in small companies is always a bit of a gamble. And really what the Entrepreneurs Assistance Act recognises is that it is a gamble. And I suspect that in order to get, that there is a lot of money out there willing to invest in small companies. We know that. Getting to the people is very difficult. And I, with respect, think the government needs to re-swing its whole compass with regard to risk. Somebody mentioned that Royal Bank of Scotland knocked out a lot of small savers. I don't know about small investors. I don't know about that. But I did do some work on Marconi when it collapsed, for the Credit Companies Alliance, actually. And I worked out that if 5% of the register was in the hands of small shareholders from the top to the bottom, or slightly artificial, I accept, but that 5% accounted was a bigger sum of money than the whole of the market under the 350. So, you know, risk is risk. Of course there are crooks in boiler shops, and I'm pleased to say one of them went down recently for 7 years. And so that's a question of policing, I think. But we shouldn't be too protective of people if they're able to invest small sums of money through crowdfunding.
That was an idea that I think I will take away and talk to my colleagues in government. I'm going to give each of the panellists 30 seconds to sort of wrap up. But some of the takeaways for me in terms of government is we're doing well in supporting small business on the lending side, but not as well on the equity side, that London is a quality market but could do much better on tech, looking at Hong Kong and the US, and renewables looking at Europe, and that this is cyclical and we ought to just not panic but make sure that we're doing all the things that we can do to help that money flow into the hands of both startups and small and mid caps. I'm going to start at this end and work down. So, Chris.
Okay. I've only had a very brief look at the Jobs Act. I think it's an extremely good idea. I'd encourage Nadhim to have a look at it. The regulation is the biggest hurdle from getting private investors in. The struggle we have to persuade the regulators that a director of a public company can deal in his own company's shares because he may not be sufficiently experienced in order to do so is a bit laughable. So I think there is a high hurdle from the health and safety equivalent in regulation. I would very much hope that the small company sector will show some resurgence come the autumn, and I think anything the government can do to give us a stable platform will encourage that.
I'd say there's a raft of small companies, a number of which I'm sure are in the audience today. If you demonstrate an ability to manage it during current circumstances and push on through when and if the economy recovers, that will be demonstrated in your results and therefore your valuation.
In the words of a famous investor, you pay a very high price for a cheery consensus.
Thank you very much indeed.
Name that investor in one.